and thank you for joining us today. I'm Robyn Conway, GM of Managed Funds, and I'm joined here by our Chief Investment Officer, Ashley Gardyne. We're going to go through some questions of what's been going on of late. Now, Ashley, it's been a month or so since we last caught up, and there's been a lot going on in the world geopolitically. So perhaps we should just start by discussing what's been happening across financial markets through June.
Yeah, and I'm sure we'll get to Iran in just a minute, but to start June, it actually started off as a pretty good month in share markets, and global markets at mid-month were up about 2%. And part of the reason for that is that the economic data was coming in pretty good. So in the US, despite everything that's happening with the trade war, we actually had the economy still adding jobs. The unemployment rate came in better than expected at 4.2%, and inflation actually came in lower than expected. So the economic impact of the trade war wasn't showing up in the numbers, so markets quite like that. Mid-month, we obviously saw a real burst in volatility with the flare-up in Iran. But as we come into the end of the month, again, markets have largely recovered from that. So it's been a pretty good period because the markets have been balancing out what's been happening geopolitically with the strong underlying fundamentals.
Now, obviously, there's been a lot of focus in the last 2 weeks on the situation in Iran. How is that impacting oil prices and share markets, and what are the risks from here?
It does feel like whatever I say could be outdated really quickly because things are evolving rapidly at the moment. But for now, it looks like we have a ceasefire. But initially what we saw in response was what we've traditionally seen when there's been escalations in the Middle East. We saw oil prices spike 10 or 15% in a couple of days. We saw a bit of a sell-off in share markets, but it wasn't overly significant. But since the ceasefire, we've seen oil prices come back down and share markets move on to recover. And I think the big risk that people were worried about and is still out there is if things escalate again, do we get a shutdown of the Strait of Hormuz, which is an extremely important strait for oil. About 20% of the world's oil flows through there. And if that was to be shut down, we could see oil prices back above $100, and that could have a real impact on the global economy. But I think if we take a longer term view on it as well, we've seen lots of these escalations over time in the Middle East and different wars. And what often happens is world supply chains adjust, the oil supply adjusts again through time, and markets ultimately move on to recover pretty quickly.
Yeah, thank you. Now, there has also been a lot of focus on President Trump's big, beautiful bill, which includes quite a bit of spending and tax cuts. What are the implications of this for US debt levels, and what risks does that create?
Yeah, it is something that we're following really closely because the US debt levels are really getting up there again. They're up close to 100% of GDP, which is almost where they got to after World War II. So at some point, the US is really going to have to address their deficit, but also their debt levels. And the big, beautiful bill does have quite a lot of tax cuts and spending implications. And essentially what he's trying to do with that is extend the tax cuts he brought in 2017 and also provide some other tax cuts he promised during the election for no tax on tips and overtime, for example. But he's also looking to boost spending on defence and border control as well. So there's a lot of spending there, and overall it can result in an extra, say, $3 trillion of deficit over the next decade. So that does create a bit of a problem. If the debt gets too high, the markets won't like that. But for now, the market seems to be taking it at its stride.
Yeah, okay, thank you. Now, if we move a little bit closer to home, New Zealand GDP growth for the first quarter came out last week. What did that tell us about the New Zealand economy, and are there any signs of improvement yet?
Yes, I mentioned earlier that the US economy is looking pretty resilient, but we know in New Zealand it's been a lot tougher. The last couple of years here have been pretty hard. House prices have been really weak. Immigration's been low. Tourist volumes haven't come back to the pre-COVID levels yet. So it's been a more difficult period. But what we did see with the first quarter GDP, which came out recently, was a slight pickup in the economy. The economy grew 0.8% quarter on quarter, which is actually better than most people were expecting. And there were some positives in there. And if you look at some of the business sentiment survey as well, you see some positive notes coming through in areas like agriculture, but also professional services were a bit better than expected as well, offset somewhat by a still really sluggish retail and construction sector. I think, though, if you fast forward a little bit, though, because we do have a farming sector that's doing quite well at the moment, and we do have interest rates that have come down quite a bit over the last 18 months. As people start to roll off their fixed mortgages onto lower rates, I think that will provide a bit of a boost to the economy as we move into next year.
The official cash rate was recently cut in New Zealand. Do we expect more rate cuts this year?
Yeah, so the official cash rate was cut by 0.25% to 3.25%. But the really interesting thing about the announcement was it appeared that on the committee there was 5 that voted in favour, but 1 that voted against, which means that it's not unanimous that everyone thinks rates need to keep coming down. And in response to that, short-term interest rates actually moved up a little bit, the exchange rate moved up, and people are starting to pick that maybe mortgage rates have bottomed. Now, I think that's probably a bit short-sighted. I think we still have a really weak economy. We still have inflation that's really subdued. And I think if that continues to be the case as we move through the year, I definitely think we'll see more cuts. And what we've seen actually in the US in the last couple of days is a similar approach from them, where they've been on hold with their interest rate cuts. But the chair of the Fed, Jerome Powell, did say that if we get a couple of months further down the track and inflation hasn't picked up because of the trade war, then they're likely to start cutting rates as well.
Now, finally, we're halfway through the year already. What would be your major reflections from the year so far in markets?
Well, it's certainly been eventful. We've had a trade war, an actual war, and a lot of political posturing from different parts of the world. So it's been really eventful. At one point there in April, we also had markets that were down 20% from their peaks. So it's easy to forget that in hindsight, but there was a huge period of volatility there. But overall, I think it's a good reminder that the unexpected happens in markets. We get periods of volatility like this pretty much every single year in markets. And it's just important to have a long-term plan and not sort of move away from that when there is some volatility.
Thank you, Ashley. Thank you for joining us for this update. We hope that you found the information informative and insightful, and we look forward to updating you again soon.